Welcome to the Outlook 2024 event taking place on this not too chilly January 31st, 2024. I'm your host for the evening, Bob Simpson, serving as Vice President of Portfolio Strategy at Wealth Stewards. We appreciate your presence here tonight, and whether you are an existing client, you've discovered us through one of our accounting affiliates, or by any other means, we extend our gratitude to you for joining us despite your busy schedules. Outlook 2024 is a collaborative effort between Wealth Stewards and Wealth Stewards' newest venture, Private Debt and Equity.ca, a platform dedicated to educating investors about opportunities in private markets. This marks our fourth Outlook event, and as in previous editions, we've curated a compelling lineup of topics. These include discussions on investment management trends, real estate markets, and the ever-increasing world of artificial intelligence. For these topics, we've gathered a panel of experts to provide valuable insights. Tonight's webinar will be recorded. It is actually at the current moment being recorded for your convenience and will be accessible through both Private Debt and Equity.ca and wealthstewards.ca. As we delve into these engaging discussions, please make yourself comfortable. We're here for an hour or so. Just sit back and see what you can learn. If you have any questions during the presentations, please utilize the Zoom control panel to submit your questions. We have allocated time at the end of the sessions for our panelists to address your inquiries. To become familiar with how the Q&A panel functions, if you want to just do something for fun right now, just click the Q&A at the bottom of your screen and type in hi, and be nice to hear from you. So once again, welcome to Outlook 2024, and let's make this an informative and interactive evening. Now, without further ado, let me introduce our first guest, Bill Chinery. Bill is the retired chairman of Ontario Teachers Pension Plans Investment Committee. And as you would imagine, he has a great deal of experience in the investment industry. He's going to be addressing recent economic and investment trends. So Bill, welcome. Thanks for coming out this evening.
Well, thanks, Bob, and thanks for inviting me. It's a pleasure.
Yeah, let's have fun. We're all here tonight to discuss the Outlook 2024. Right? Looking into the future to get some ideas on trends and what to expect over the next 12 months. So diving in, just take a look at, looking at equity markets, Bill, and how you anticipate they might change over the next 12 months. What are you seeing? What do you see?
So if we start from the end of October to the end of January, the last 3 months, you'll note that the S&P 500, the US stock market, is up over 20%, and that's been driven mostly by tech stocks. Canada has fallen short. We're up 10%. We haven't got the tailwinds of the tech industry for Canada. But what's caused that? So what happened in late 2023 is we had the Fed indicating that interest rates were going to be, that they've stopped quantitative tightening, and that in 2023 they're going to start cutting rates. So, of course, the market loved that. And in fact, the market's pricing in a cut in March of 2024, this year. Now, I don't know if you saw Chairman Powell today, but he indicated that he doesn't look like we're going to cut in March of this year. And so immediately the stock market fell off 1.5% in the US and 1% in Canada. So that's an interesting signal. So what do we think will happen in 2024? I think if the Fed can cut appropriately, get inflation under control, get it between the 2 and 2.5% that they wanted at, get unemployment where they wanted at, get the GDP growth at 2% or so, and hit that what they call the perfect soft landing, then I think we could see single-digit rates of return in equity. So I think they've already priced in a pretty high rate of return for 2024 with the 20% increase. So if they can do that, I think we could get a 5 to 10% rate of return. If not, we're probably looking at flat to perhaps negative interest rates or rates of return for equities in 2024.
Yeah, Bill, one of the things, one of my barometers that I watch really closely is the US 10-year bond yield, the treasury yield, right? And, we all make predictions, and, predictions are about as good as the paper that they're on. But my prediction was that, we should be buying equities when the 10-year bond yield hits 5%, and it hit 5% and then just immediately dropped from 5 down to 4.8, and now it's kind of hanging in there trying to figure out what to do next. Is that, how much of that can we anticipate? Should we be watching the short-term rates? Should we be watching longer-term rates?
So you're right. The 10-year is now hovering at about 4%. Now, of course, it's an inverted yield curve. So what do we mean by an inverted yield curve? It means short-term interest rates are up around 5%, and the long-term rate, the 10-year, is at 4%. So generally, that says we're looking at a recession in 2024. So something has to normalize those rates. So what's going to happen? Well, hopefully the Fed cuts so that we get that yield curve to go to steepen, which is what we want in a normal economy. So I think the Fed will be cutting in 2024. So there should be at least, I think, 1 or 2 or 3 cuts. And if that happens and we get that curve, as you say, get up around 5% for the 10-year, I think we're looking pretty good. I don't know if that's going to happen, but that's kind of what we're looking at.
Yeah, but that's what we really saw just in the end of October, wasn't it? That the 10-year moved up and flattened out the yield curve at around 5%. And then start to anticipate that rates were coming down, and then it just inverted again, right? So
Correct.
I think everybody's been watching that inverted yield curve, looking for a recession. Do you see a recession in the near future?
So my bet is no, simply because 2024 is an election year. I think the Fed is cognizant of that, and it will do its darndest to make sure that the economy doesn't go into recession. So if they see unemployment spiking at all, I think they'll worry more about that than, say, inflation, and I think they'll start to cut. So I would see less than 50% chance of a recession in 2024.
Mm-hmm. Does the Fed watch the Fed watch the equity markets?
They say they don't. They say they look at really unemployment. They look at GDP and they look at inflation, and inflation's still stubbornly above 3. Unemployment is actually working nicely right now, and the growth in the economy is good. So that's why they're still hesitant to cut, because inflation's still reasonably high, the economy's still moving along nicely, and so they're just waiting to see what happens.
When you and I spoke a week or so ago, I used the term high interest rates, that we're experiencing that. I made the comment that, to me, 5% interest rates, those aren't high. What a lot of us baby boomers saw when we had 14 and 15% mortgages, that's high. Do you see in the interest rate market moving forward, do you see that we're going back to the real low rates that we saw during COVID? Or where do you think rates are going to settle in?
Well, I think a 4 to 5% 10-year is perfectly placed. So you're right. I remember the early 80s when I took my first mortgage, it was like 15, 16%. Our kids now don't even understand that when they have houses. But the sticker price, of course, of our houses is a lot different than today than it was back when we were there. But I would say we can land at 5% 10-year. I think that's the Pollyanna scenario for the future. And if the Fed can keep it 4 to 6%, I think that's great.
Yeah, and usually that's what interest rates do. They like to sort of find that stable area. They don't really move around a lot. They'll sort of shift from one area to another. Is that your experience as well?
That's exactly right. I mean, there's few times in history where you can predict exactly when interest rates where they're going. But for instance, a few years ago, of course, when they were 0, there's only one way they could go, which is up. So that was one of those seminal moments where you knew that it was good, interest rates were going to rise. And then, of course, right now, at least for the next year, I think you're pretty certain that short rates will be cut by the Fed. So that's another seminal moment where you're pretty sure we'll have a lower Fed fund rate at the end of the year than we do at the beginning of the year.
Yeah, now in your initial comments, you talked about that, we had that big move. I think it was 18% in November and December, and then we've had a little more follow through right now. And you said there was leadership in the area of technology. If you look inside the market, where are the opportunities? What are you seeing? Where should we be focusing our attention?
Well, of course, and we're going to hear this later on about AI. I mean, AI is the buzzword now in technology. If you have any kind of venture capital fund and you're starting out in technology, the first thing you talk about is AI. And the question really is it AI or isn't it AI? But I think that's going to be revolutionary. It will be as big as the internet. It will be big as the creation of electricity. It will be that type of event. And so I think looking at anything associated with AI is what's going to drive technology for the next 5 years.
Yeah. Now, if we look at the aging economy, the baby boomers are all reaching retirement, or I think I saw that they're reaching old age, right? That the oldest baby boomers are now in old age. Is that, do you look at areas like healthcare as opportunities there?
Absolutely. Healthcare's, retirement homes, sad to say, funeral homes. I mean, those areas are going to be big going through the next couple decades. And you're right, the baby boom, our population around the world, and one only needs to look at Japan as a population where actually less kids are being born than dying, which is nobody's actually encountered that yet. The population is aging in North America, but we still have more babies born than people dying. So those are going to be the areas for sure that will, in the long term, do well. And you just have to figure out which areas within healthcare and retirement homes, et cetera, are the best place to be.
So with the the large millennial group, is North America becoming rather than sending business off to other countries, are we going to see more production, more manufacturing in North America?
I think so, for a couple of reasons. First of all, the globalization, which is everybody's started to pull back around the world. You saw that in the U.S. tariffs created during the Trump administration, so that everybody, and then the supply chains that got choked during COVID, people realized that we've got to start building the chip plants in North American soil. So yes, I think we're going to see a lot of that, and it's going to be driven a lot by robotics. So we won't need as much labor, and so we'll be able to generate the chip plants in North America because the labor will be limited and not as extensive as it was in the past. So robotics is going to be the other thing that will complement AI to allow everybody to build things in North America again.
Now, one thing that we have questions about is our focus has primarily been in North America as opposed to being international. We've just identified that the best companies in the world happen to be in North America. What's your view of we all should diversify, but diversifying internationally?
Yeah, for sure. Canada is only 3% of the world GDP, and also the stock market. So, of course, you want to be diversified. Canada is dominated by financials, by utilities, by oil and gas. If you want tech, you're going to have to go outside of Canada, and you see that with the Magnificent Seven. I mean, so I think I mentioned this to you a week ago. If you look at Microsoft, it's larger than the Toronto Stock Exchange. One stock is larger capitalization than the Toronto Stock Exchange. If you look at Microsoft and Apple, it's larger than those two stocks are larger than Canada, the UK, and Japan stock markets. I mean, that to me is mind-boggling.
Yeah. Yeah, you threw that number at me the other day, and and it wasn't something that I'd ever contemplated. That's an amazing number. Anyway, Bill, thank you for this. We try to keep it real tight. You're gonna hang around for a bit so that you can answer some questions at the end. Yeah, so thank you. Our next guest, Sasha Cucuz, is CEO of Greybrook Securities. Greybrook is one of the leading real estate private equity firms with more than 100 large-scale developments across Canada and the United States, serving over 10,000 investors worldwide. Sasha leads his firm's capital markets and investment strategies, and under his leadership, its investment portfolio has grown to be valued at over $35 billion. He will be providing insights into the Ontario real estate market. Now, before we get started there, Sasha was got on a plane in Dallas this morning, in Texas, at 5:30 a.m. And so we want to keep things moving so we can keep him awake here as we do this.
I'm good. It was sunny there.
Yeah. So Sasha, let's just start that, what we want to focus in on this evening, and I think a lot of people are interested in the Ontario and Canadian real estate markets. What do you see? What's your view? And, I know I've heard you quote lots of stats over the years about what's happening, but what's your view of real estate in Canada right now?
Well, my purview is primarily residential. That's where we focus most of our investment strategies. I would answer the question this way. Real estate is inherently a long-term investment, right? When you talk about equities, when you talk about many asset classes, it's a long-term investment. And I don't know that from my vantage point, any of the fundamentals that we rely on when we make investments have changed in the least. There are certain exogenous factors today. Interest rates are higher than they've been. We've seen that shock. We just went through a pandemic, which constricted some of our labor supply and caused material prices to get a little bit distorted. So that's an exogenous shock. But we have a tremendous amount of population growth and an inability as an industry to supply that population growth with adequate housing. So that imbalance puts a general and pretty unrelenting upward pressure on pricing over a long term.
Yeah, and you're always in the talks that I've seen you do. You talk a lot about immigration too, and I've read. I think there've been some changes in the way that real estate's being viewed by the governments right now. Can you just address that?
There is. I mean, I think if anything, the population growth we've seen over the years has highlighted the fact that our infrastructure has simply not kept up at the same pace. Part of that has to do with the fact that immigration policy is set federally, and then at the end of the day, when the rubber hits the road, housing is a provincial or municipal ultimately function. And they don't always communicate particularly well. So we have an underserviced housing market, and as a result of that, it's turning a lens to immigration. And are we doing it the right way? What kind of changes can we make? Can we, put some guardrails on our immigration policy? The one thing I would just say to that is that, whatever side of the political aisle you're on, our reality, and Bill mentioned the fact that we have, the boomer population that's now sort of the exiting the workforce and going into the years where they require pensions and social assistance and all of the things that we provide. We have to replace those folks with the working age population that's sufficient enough to be able to keep up with our growth. And with organic, household sort of birth rates being lower than they've ever been, immigration is really the only way that we can do that efficiently.
If you compare Canadian immigration rates to US immigration rates, how do they compare?
On a nominal level, they're similar. As a per capita, on a per capita basis, obviously we have a much more aggressive policy in Canada. So we're 600 to 1 million people on a base of 34 million people, whereas in the US, they may see those numbers on the base of 10 times that population. So it's absorbed a lot differently. The other key difference is the fact that in Canada, we have 3 metros that have over 2 million people in them. So people that are coming from places where they live in urban context and want to live in urban context in Canada, where the jobs are and where their lifestyle is accommodated, you really have a couple of choices. One of them has some language barriers in Montreal. So the US has 40 metros that have over 2 million people. So the dispersion of immigration is a lot different in the US. It's a lot more concentrated in Canada. And we're seeing the impacts of that because we have not only a high nominal rate or per capita rate, but also it's very concentrated on where that immigration settles.
So although it's concentrated, what we're seeing, especially in the GTA, we're seeing that the boundaries expand, aren't we?
Well, it's required. I think, the types of housing that, just to put it simply, is you have ground related, which are things like single family homes and townhomes and semis and things of that sort. And then you have high rise, which is higher density. Families require all different types of housing, right? You have people that are students and single people. You have people that have families of 4, 5, 6, whatever that number may be. So in order to be able to achieve these targets to accommodate the level of growth that we're seeing, we need various types of housing. So it's not enough to just keep urban boundaries as they are and rely on density or intensification to fulfill those requirements, because that will only lead to high density formats of housing. So it usually has to be a combination of urban boundary expansion to increase the amount of land available so that you can have ground related options for people as well.
No, I try to keep up with these things, but things are changing so much. What's going on with approvals right now, with permits and that sort of thing? Has that tightened up, or where we stand?
I would say on balance, we're slightly better than we've seen over the past few years. I think that the provincial government, through policy, has certainly shown an intent to try to accelerate these approval and permitting periods in order to be able to cut the red tape and get things built quicker. But at the end of the day, you're dealing with many different levels of government, from provincial down to municipal, and drilling down even, you're not dealing with a mayor, you're dealing with every single ward and its constituency. And because it's a very inclusive process development, you're consulting with, neighborhood groups and businesses in the area. And, Bob, if you and I were in a room, it'd be hard to get us to agree on everything in a concise manner. So when you're trying to round up so many different constituents and get to a place, it takes a very long time. So notwithstanding the best efforts of government, both municipal and provincial, we've seen marginal improvement, but hopefully it's trending in the right direction.
Yeah, in one of the areas, I was in Texas like you fairly recently, and if you look at the city of Dallas, it's just spreading like crazy. But
yeah,
if you look at the quality of the land that it's expanding on, you're not going to grow a lot of stuff on there. Whereas in Ontario, we have some of the best farmland in the world, right? So, is that a factor? I know that we're seeing the expansion into agricultural, and I don't want to open up like the most crazy upsetting discussion, but how do you view that?
I don't think it's a hard discussion at all. I mean, I think it's a balance, and we have needs based on our growth, based on the infrastructure and housing requirements. And unfortunately, those needs involve different types of housing, and land is required for that. As it relates to other uses of land, there's an abundant amount of arable land in Ontario. We're finding more and more ways to make it productive. And I think the development community, largely wants to work together with other industries as well as the government to be able to find solutions that make sense. And a lot of times it's not a function, Bob, of like more and more land. Sometimes as cities expand, sometimes as their population disperses, sometimes some parts of land that are not developable today make more sense as developable land, whereas others that might be developable may not make as much sense, right? Because sometimes these decisions were made many, many years ago, and as cities have changed, it makes sense to trade these lands. So even in this whole, Greenbelt scandal, not going to comment on the process and all the various things that could have been done better, it was really a trade at the end of the day, right? So they weren't necessarily just taking land out of the greenbelt and not replacing it. They were swapping it for other land that was being put into the greenbelt. So I think it's always a combination of being able to maintain enough land to maintain our agriculture sector and all the things that we need from that perspective, as well as to be able to create, as I said, the various types of housing that we require.
So as a private equity firm in real estate, you know, you're doing single family communities, you're doing condos. Just talk about those couple of markets first, and you know, where do you see the greatest opportunities right now?
Well, I think, again, going back to the whole long-term mindset that we operate within, and if those fundamentals have not changed systemically, which I don't believe they have, our appetite is as it was a year ago, 3 years ago, 5 years ago, to buy different types of development opportunities that fulfill different housing types because they all have their place. What I'd say is that the dynamics of these markets are very different. So if you think about a condo market, is largely driven by investors, right? And people, you know, think of that and it's a bad word. The government has made that a bad word. But I've been very careful on the committees that I've been a part of with government officials to help them distinguish between speculation and investment, because investors are a very valuable part of the ecosystem in the production of housing. For example, a high-rise building, from the time you buy it in pre-construction to the time it's delivered, can be 4 or 5 years or sometimes longer. People aren't generally making life decisions on 5-year intervals. It's usually an event-driven circumstance. I have to move because of a job, or we had a child, or whatever the case may be. So as a result of that, investors fulfill that function on the high-rise side. Whereas on the low-rise side, investors are just less required, because the time to delivery from the time when you buy a new house in pre-construction to the time it's built is about 12 or 16 months. So a lot of times people can make those plans. So it's a very end user driven market as opposed to the investor driven condo market. Not one is better than the other. And that's something that I have to be very careful when I'm explaining to members of the government who sometimes try to vilify the role of the investor, when at the end of the day, it's an essential part of the ecosystem that produces housing for end users.
We've had the shift from lower rates to higher rates. How has that affected the market? How are developers looking at that? How are private equity firms in real estate dealing with that?
To call it a shift is understating it in my mind. It was like, you know, really the magnitude of the increase more than the absolute number. You were mentioning, you know, back in a different time, they were higher. And even 5 years ago or 7 years ago, we had rates that were at or near the same level. It's where we've come from and how quickly, and what that's done from a market that's repriced over the years. And I think that the way we think about it is, you know, obviously there's some cost issues on the construction side, because you have construction loans and various forms of financing, and obviously those forms of financing are more expensive, but that's generally been really manageable. And I think as we relate, as it comes to acquisitions today, you know, we don't like to try to forecast too far into the future. That's why our acquisitions cadence has been slower, because we're looking at the rate environment today and saying, look, we don't know if it'll be 12 months or 24 months where we start seeing a little bit of a rollback in rates. And, you know, Bill, I think I agree largely with Bill's perspective on this, but what that's done is effectively just slow down our acquisitions. We're taking the time to digest what we have, make sure, you know, we're well capitalized to be able to absorb the costs in the projects that we're continuing to build and deliver. And then in the new acquisition realm, we're kind of taking a wait and see approach. And then when we get comfortable enough that we'll see some relief on the horizon, I think that's when we will be turning the taps back on. And in our mind, that's kind of started. And we've been very aggressive on new acquisitions over the last month or so. So we should be ready to go with a couple in the next month or two. Yeah,
no, it's awesome. Well, I know it's been a long day. Hopefully you can hang around, answer a couple of questions.
Yeah, I'll be here.
Have a little 15-minute nap while we shift our attention to.
Perfect.
Yeah. So thank you. Thanks for doing this.
Thank you.
Yeah. So as we shift our attention to Prathna Ramesh. Now, Prathna is Vice President Operations at FutureSight, which is a venture builder that backs North American software and AI entrepreneurs as institutional co-founder with capital. Prathna has a great deal of experience in early stage investor and operator in the B2B software and AI, just to throw some letters at you. And she's going to be speaking about artificial intelligence. So Prathna, thank you very much for joining us this evening.
Hi, Bob. Thank you. I'm a
And there
little
she is.
offended, though, that you told Sasha he can take a nap for 15 minutes during my session. But
Right.
anyway.
But he could take a nap, but he's not going to want to.
Uh-huh.
Because you're actually going to talk a little
I'm
bit,
awake.
maybe even AI in the world of real estate, right? So I think it might be something he wants to tune into.
Cool.
So I'm going to start you with question number one, which is interest in AI. Both, really, as Bill said there, it just has exploded. It was almost like the equity markets were going nowhere, and all of a sudden, AI just jumped out of nowhere. Like that's the way it seemed, right? It had been there, it had been growing, but it was almost like one day, holy geez, have you seen AI? That's something interesting. Maybe we should go. Can you take a quick look at, give us some insights into your view of the current landscape of AI technologies?
Yeah, and it's interesting that you say that all of a sudden it wasn't there and then it was. One thing I would want to state up front is that AI is not new. I've been investing in software and AI for the past 7 years. And back then, when we were just starting out, we were living under the halo of Mark Andreessen's words, software will eat the world, right? And we were starting to see more AI companies as AI startups were pitching for funding from venture and angel investors. And we had gotten to a point where we were starting to see it was almost like a checklist that we felt startups had in their head, which is present AI, blockchain, or IoT technology without really a sense of exactly how to implement that in their business. So it's I think over the past 5 or 6 years more so, I've started to see a shift where it's no longer software is eating the world, but rather AI is eating software. You're hearing that more now. I'll give some examples of investments that we had made around 2015, 2016, which, I don't know if it would have been in the press, but there was meaningful capital deployed behind it. So for example, one was a computer vision company that does sports analytics for the NHL or different sports teams to just help using footage to help players get better. That's an example of an application of AI. Or of course, you have your Alexa and your voice assistants at home. And we were doing sort of more nuanced and more accurate versions of those voice investments. So what I would say about AI broadly is there's been a lot of buzz, a lot of great chat about it. And this explosion has occurred since 2023, basically, right? And that was because of OpenAI and ChatGPT. So if we were to just think about the technology, I would look at it as predictive AI and generative AI. Predictive AI has been around for a while. It's those examples that I listed, when your model is able to recognize a pattern and is able to make an outcome or a suggestion or a prediction based off of it. This generative AI, which is newer, is when the machine is creating net new content from scratch. So text, videos, audio or code even, whatever it might be. And it feels like it's not different than the time of the internet, exactly how Bill was saying at the start, right? But there's definitely some fear mongering happening. The thing I will say though with ChatGPT, what they did is they made it so user accessible. They were able to get 100 million users in 2 months, right? And if you look at Instagram or Uber, these companies reach that sort of threshold in a span of 30 or 50 or 80 months, right? So it's getting more and more common. And, people like Mark Cuban are coming out and saying, you have those companies that are great at AI and everybody else. There's no in between. And the last thing I'll say, Bob, is you got to follow the money a little bit and see sort of how the investments have been tracking over this last period. So there's record-shattering numbers around investments in AI over the last few years, especially in 2023. But a few considerations, right? Most of that capital that was invested went into these large foundational models like OpenAI, which require a great deal of investment and a great deal of time. A lot of the new capital that's going in, investors don't have the time and or the money, frankly, to compete there with a Google or an OpenAI. So they're going to start looking at these vertical specific AI, and I'll talk about that as well. Another consideration as to why you've seen the level of investment is a lot of capital was raised by these private funds, and given the risk-free rate, there was a lot of pressure as well from LPs, institutional and individual, that, hey, you need to deploy the capital. And it's possible that because of that as well, you saw like a pretty big uptake, and it very well aligned with this new tectonic shift, basically, in technology, which is at the magnitude of the internet, to be honest.
Yeah, so based on your comment about Mark Cuban,
Yeah.
Are we going to see that the large multinational companies, the Googles of the world, are going to be the major winners, major players in this area? Others just won't be able to compete with the big guys. Is that why we're seeing such explosion in, the sort of large seven there that Bill talked about?
Yeah, it's a great question. And, initially, before I started really diving in and learning about this, my answer would have been yes. But now that I've spent time sort of studying the industry, you quickly understand that there's actually 4 different areas where you can play when it comes to AI. You have the hardware layer. Think of that as like the core of the foundation. That is where you have your supercomputers or the semiconductor chips and that kind of thing with the NVIDIA, Google, etc. Then you have a layer above that, which is you need cloud computing power to run. And so that would be Azure or AWS. Then you have the layer which is developing these models like GPT or Bard from Google or Meta's Llama. And those require a crap ton of data in order to be able to be effective, because they're basically mimicking the Google search, right? So they need to be effective, and they need a lot of time and capital to be effective. And then you have this layer of the application layer, which is more like something you and I would be able to use if we went on a Midjourney or a Jasper to have, instead of you writing your notes for this event, you might input that with information and say, these are some past events Bob has run. This is his tone. You train that to sound like you. And then you say, I'm hosting Outlook 2024 with these people. Give me the list of questions. So I would say these are the 4. And when it comes to the first 3 foundational layers, I think you're absolutely going to see the big players win. It's this last layer in the application space where all the, private capital that is not at the mega zillion dollar level is focusing on to see if we can find some winners. But the truth is, you don't know. It's still too early.
Yeah, it's always difficult to predict, isn't it? Now, anytime there's something new, anytime, there are dissenters, right? People who say, this is bad, this is going to change the world, they've got to shut this down, it's going to ruin education, it's going to ruin a lot of things, right? What are your views about, the positives? Computers. Yeah, you don't want computers, they're going to take jobs away. Computers can do the work. Where's that stand with AI? Like, what's your view on possibly some of the negatives and how they're not really negatives?
Mm-hmm. Well, on the job displacement piece, robots have been about to take over human jobs for almost 100 years, and really since the introduction of electricity. So I think that someone said someone framed it well for me, and it has stuck. AI won't replace humans, but humans with AI will replace humans not using AI. And so that's interesting to me. Some jobs will get lost, but I don't think the challenge is going to be like trying to understand how to implement AI in your business. If you are, as a business, working with software and technology, it's likely that if the software companies that you're dealing with, like even if you're a massive legacy business working with SAP, you're going to start to see AI in your life every day. And that's the very cool and exciting part about the life, so the time that we're in. The real challenge, I think, when it comes to, Mark Cuban's comment about those that will be really good at it and those that will not, is when it comes to organizational change, like people's willingness for learning and change management. And then, yeah, I've also heard, will AI kill us all? That's an interesting question. Is humanity gonna be taken over by robots, basically? I think everyone's afraid of this really super intelligent AI being created that will destroy humanity. The truth is that, I mean, it's not a very sophisticated answer, but we can either spend our time minimizing the harm that could come from this potential devil, or we would, just prevent the systems from existing at all and the good that can happen. So my view is quite bullish. Obviously, I'm a believer in the industry. And it's one of AI has the potential to solve real problems like climate change. But I think and you're hearing this for sure, the ethical guidelines have to come together. And you see this with any new technology, be it nuclear, you have anything that has like a massive impact potential, you see regulation come into play. So I feel bullish about that. And then I guess the other important thing that people are starting to think more about is executing ChatGPT takes about 100 times more energy than doing a Google search. And so that, in combination with our issue related to climate change, is going to be an area where people have to spend energy.
Yeah. It's interesting that there's a software program called Storyworth where you can, have you ever seen that?
No, let me look it up.
Software?
Yeah.
It's where you sign up and you write your own book and they send you questions every week.
Right.
And, I go in and answer the question. I do the best I can. And then I take it and dump it into ChatGPT and say, rewrite this so that it sounds, halfway, like I'm a decent writer. Does an amazing job, right? And I think, just little things like that are nice in that they sort of introduce a positive thing that pretty much anybody could use, and just keep moving things forward. So, yeah.
Yeah, I had come across, I mean, there's it's now getting like increasingly easy, less expensive and easier to build businesses. I think that's an important thing for everybody to keep an eye out for. That we said that when it was the era of cloud, and we were seeing software being created. Now you're having these other functions, like for instance, you might be able to get an initial version of your product out to market without really having a team of developers. You might still need a layer of oversight. So you might have that taken care of. You might have all sorts of marketing content and branding, them creating websites for you. So it really is an exciting time, which means that you either pick a few people that you're going to follow when it comes to thinking about how to invest, or just be curious about it because it's going to impact all of our lives meaningfully.
Yep. And the rate of change is going to be tremendous, isn't it?
Yeah.
Yeah. Now, when we talked a week or so ago, you mentioned the use of AI in the area of real estate, and we're discussing real estate. Tell me about that.
Yeah. Many applications actually. So if I were to just think about, I think from end to end, every step of the process, and you know, Sasha should also be one to weigh in here. Any problem that you're dealing with through that cycle, AI can support. So one interesting application is to support with the sales and lead conversion and lead closing, and assist basically home buyers and sellers with the entire process. Increasingly in this day and age, people don't want to talk to agents, or they're busy, or they don't want to pick up the phone and that kind of thing. And so you can have a really effective conversational AI agent and a team of agents and a mortgage agent, which are all synthetic, AI based, which have been trained well, communicating with you. Now, you often hear when it comes to real estate, if people are making this home purchase or sale, this is, you know, an important financial transaction, and can they get through it without any human intervention? So some of the startups that I'm seeing that are doing, you know, these AI-based solutions are also concurrently building a human base to support with that. So this falls under the category of co-pilots when you look at AI and how it's maturing. So where you have a human being assisted to do better and be more effective with their time using AI.
Yeah. You know, great insights. We appreciate you coming and taking the time tonight. We're going to address some questions right now. If anybody has questions, remember down at the bottom of the screen, there's a little thing that says Q&A. I've got a number 2, so we've got a couple of questions there. You know, remember, they're not really bad questions. If you're interested, just pipe up and send us what you're thinking. I'm going to open up this the Q&A panel and just see. One question we have here is, can Bill comment on any trends in institutional towards private debt and equity versus public market investment?
Okay, Bob. So on that question, I saw that in the Q&A area. So when I joined Teachers Board 8 years ago, about 30% of the assets were what's called private. So let's call that real estate, private debt, private equity, and infrastructure. Now those are over 65% of the balance sheet of teachers. And so obviously there's been a big trend there. Now, why would they invest in those areas? Well, if you take at least 3 of them, debt, infrastructure, and real estate, I mean, they throw off income. A pension plan like teachers have 1 active for every retiree, and so they need to have that income to balance off their liabilities. And so it fits in very well. And I think also the question is that I saw in the Q&A was, does that fit in with your investors, your wealth investors? And of course it does. I mean, it's an older population. They have liabilities that are very similar to teachers' liabilities, and so they would fit in. The challenge for private wealth people is to do it in such a way that it can fit into a series of funds. Teachers don't have funds. They buy private equity directly. They buy debt directly. They buy real estate directly. So they don't have that challenge. So as long as you can overcome those hurdles, it fits in very nicely with a high net worth individual.
Mm-hmm. And I think you talked about 3-year volatility when we talked the other day.
Yeah, if you look at teachers, for instance, in 2022, if you remember, the equity market was down 10%, the debt market, bonds were down 10%, teachers made 4%. Why did they make 4% positive when everything else was down 10%? It's because these don't move as quickly as public markets. You can smooth out the returns. And again, that fits in very nicely with high net worth individuals.
Yeah, I think so. Looks like we might have some questions over in the chat area. Let me just see if I can open that. And while I do that, question: with housing valuation metrics such as rent to ownership, price to income multiples, and many other metrics at historical highs, is it sustainable with evergreens collapse and the highlights of highly concentration in real estate in individual holdings as estimated 70%, Canada also being very high. Do you have concerns, Sasha?
I mean, we have concerns every day about a lot of different things, so it's never a straight line, as you guys would all know as investors. I think that you know, the price to affordability in general is always a concern, and you got to think about real estate as an asset class, but it also has to be accessible to its users, and its users being either those that own it or those that rent it. And you know, expensive global cities, as they transition from ones where most of the people who live in their real estate own it, they over time, you know, become asset classes, stores of value, you know, the Londons, the New Yorks, the Parises, different places like that. And there sometimes can be a disconnect, and when that disconnect gets too wide, obviously there's concerns. We look at rents a lot, so oftentimes the ownership of real estate can be out of reach for sort of an average household income. That doesn't necessarily mean that rental rates are not accessible. So you know, ultimately there's a lot more renters in the market. When it comes to ownership and price to income as a measurement, to me, it's always been a bit of a flawed measurement. I'm not going to say that it's not useful, but if you think about it, it's measuring your income in one calendar year to your obligation of a house over 30 years in some cases with the amortization schedule. So it's not necessarily always a fair or accurate way to determine affordability. The second thing, I think that more importantly, affordability comes, it can be discussed in terms of the payment, and is the payment affordable? But the way to lower the payment is to increase the deposit in some cases. And you know, we as we talked about with the boomers becoming the larger proportion of the population, we have some of the highest, or if not the highest ever, wealth transfer that's going to be occurring or has started occurring and is going to continue occurring over the next 10 to 20 years. That comes in the forms of transfer of cash, transfer of assets, transfer of housing, and the equity that's been built into housing. So there are ways to mitigate affordabilities as cities become older and attract sort of investors into these markets. So would I say it's a concern? Definitely. Do I think it's sustainable? Yes. I mean, I think this is not atypical of any major city around the world where we've seen similar phenomena. The question about Evergrande, which is a Chinese property developer, I believe that's the reference. You know, there are a couple things, notwithstanding the way the property market in China works is very different than the way it works in Ontario or Canada. But the biggest difference is, to me, it's all in the way that you capitalize your projects and the way that you capitalize the developer at the end of the day. Evergrande took on a lot of debt. It took on many multiples of debt to ratios that probably were not sustainable in the best of times. And then when things started to get rocky in the market, in the property market, they were just simply you know, not able to keep up with those obligations. And that was a function of, I think, poor financing on the part of their management team and board, ready access and cheap access to capital probably. But that doesn't mean that you know, like if you're in a kitchen and you have 15 hot dogs, you don't have to eat them all. So if you capitalize yourself responsibly, the way we do it here, for example, is we don't take on any balance sheet debt. Every project is its own special purpose vehicle. It's uniquely capitalized, and we're very equity heavy. So at the end of the day, that might hurt your equity multiple because you're not using as much leverage as you probably could, but you're also decreasing your risk profile at the end of the day. So we're very careful about the way that we capitalize our projects to not end up in situations of insolvency. Again, the Evergrande thing was a little bit different because it's at the balance sheet level, but even at the project level, you probably read in the news in Canada, there's been developers who have got themselves into trouble with over leveraging their projects and having to, you know, avail themselves of bankruptcy protection. That's something that, of course, there's concerns around it, but if you do it responsibly, you're sacrificing some upside, but at the same time, you're protecting yourself on the downside.
Yeah. So don't chase returns, but look for quality deals that are properly levered, right?
Yeah.
Prathna, as AI continues to evolve, how can financial professionals, business owners, investors stay informed on the changing on the changing landscape?
Oh, staying informed is there's I mean, there's plenty of airtime that AI is getting from the media. I think that if you wanted to critically analyze the opportunities that make the most sense for you, then yeah, I think it's very real. Like people are thinking about how to use AI to become better investors. Banks are investing meaningfully in using AI co-pilots to provide advice to clients. You might also be able to, as retail investors, search for these sort of AI financial education tools where you can have a chat-like conversation over an interface and just get better educated. I know in the crypto space, they do have a few good products like that. Then you think about how to use AI to become better operators. There are like a plethora of changes that you can make within your operating business, be it sort of tool management, data management, email software. And then if you've got, you should probably take an assessment in each of your departments and think about and have your department leader come up with some thoughts around how they think. Maybe you want to list out what some of the biggest pain points are today, but also you just got to force people to do the work and read and learn because all of this is kind of changing in real time. And then the next big question I guess people have is how you can invest in AI, right? And there's the public route and there's the private route. And I mean, there's pros and cons for both, for sure. We talked about the different layers, but on the public side, you have some of the hype priced in already, but information, of course, is readily available. On the private side, I think you can have good opportunities for high multiples, but there's a lot of noise. And so I think that how to win on the private side, which is what we've been focusing on, is create a process to learn how to kind of cut through the noise and understand for this technology now that's out there that people are using, again, what are the commercial opportunities and what pain point is it solving today for the end user, the end customer? And some of this only time will play out, but in the next few years, the adoption is going to double, triple, quadruple. And I think following where the investment dollars are going, VC and later, is a good idea.
Yeah. Now, Bill, the private investor, the individual investor, hasn't really kept up with the shift to private markets. What's your view on that?
Well, that's true, Bob. They haven't kept up, but as I mentioned, it's a little harder for a mutual fund, for instance, or even an ETF to have a real infrastructure fund. The ones that do have infrastructure ETFs, they're the public market ETFs. So it's not really what I consider infrastructure. So the private equity firms have to figure out how to, or sorry, the private wealth firms like Wealth Stewards need to figure out the challenges of creating pools of money that can be valued on the bases they need to be valued, and put in funds for the individual investor. So that's the challenge, and I think Wealth Stewards done that. So kudos to Wealth Stewards to figure out that to crack that nut.
Yeah, no, I appreciate that. Appreciate those thoughts. We just had one of our guests just send us something saying, can I please get a link to the recording? I want to review it again later. Of course, in our closing comments, we'll address that for sure.
Well, could I ask a quick question
Yeah,
to Bill?
absolutely.
That was awesome, Bill and Sasha. Bill, I was one of our friends in the Canadian ecosystem is actually, so we're a venture builder, and a similar player in the space is an org that's backed by teachers, which is also a venture builder called Koru. And so I was just wondering, in your time, did you start seeing a lot of buzz around AI, and what was teachers' position around all of that?
Yeah, so that's a great question. So Koru, what Koru is, teachers went to all the private equity companies and said, look, give us your best ideas in technology, AI, and we'll fund it. So come up with all these ideas. So they just asked and they have 100 companies, come up with the best ideas. And of course, they don't have the capital to do it, but teachers does. And they've come up with just some fascinating ideas that came out. For instance, I'll just give you one. For retirement homes, they created avatars so people in retirement homes don't get to see all their family members that often. So they created avatars for the family members to talk to the people in the retirement homes, much like without them being there. So it just took on the personality of the daughter or the son. And so this is fascinating stuff. And that's what Koru did with I think it was Amica. So there you go.
Yeah, I think that's interesting.
And for the record, as a real estate guys, people think of us as neophytes, but to your point, Pratt, I did not take a nap. Number one, very interesting, your discussion. And we have been very bullish on the applications of different AI in our business, whether it be things on the capital market side that make us more efficient. On the underwriting side, we're looking at and experimenting with different technologies, obviously, you know, the co-pilots and things like that to help with our reporting. But we look at this, you know, I'm not qualified to talk about whether, you know, the end of humanity is in our sights, but I certainly can look at this as a tool that will make us more efficient as a firm and make all of the people in the business, like, you know, the scare that we're, you know, going to replace people. Really, I just look at it as another very effective tool in the toolbox to help people do their jobs more effectively. And that's how we're looking at it. And it's something that our tech team has been on for the last year, at least a year. So maybe we're a little bit late to the party, but you know, not like you guys 6 or 7 years in, but certainly very excited about the future application and how it can change business.
Yeah, just like on the mortgage side, even what normally would take a human and, you know, 10 hours of work can be done in a matter of minutes. So yeah, it's very cool.
Yeah, they need to teach bankers when you go to open an account that they don't take 4 hours to put you through. You could do it with AI a little bit quicker than that. Anyway, one of the rules of doing these kind of events is start on time and end on time. And I appreciate everybody's interaction. So let me just check on my own closing remarks. So we at Well Stewards really appreciate the time that everybody, both attendees and our guests this evening, have taken from their busy schedules. People like Sasha on no sleep, you know, joined us and did that. Now, tonight's roundtable, as I mentioned earlier, it's been recorded. It will be sent, a link will automatically be sent out to each of you so you can listen again, pass it on to a friend, family member, business colleague. Additionally, you know, I talked a bit about private debt and equity.ca, which is our new website, which is developed to educate investors about this. And we interview people like Sasha, who, you know, are suppliers of products and services to our industry on a regular basis. We just did podcast number 8 this week. We've been doing them since December. So this will be a podcast. If you want to go there, just listen to it in your car. It'll be available on Apple, Spotify, any of those networks that you use. So if you want to, you can go and subscribe to, you know, listen to this or subscribe to any of the podcasts. When this webinar ends, there'll be a brief survey sent out, which will appear in your browser. We would appreciate if you take a moment to share your feedback with us. It really helps us to make sure that we're putting on the best possible events for you. as I like to say in the closing remarks of my podcast, I'm Bob Simpson. It has been my pleasure to steer you through this enlightening conversation. Keep in mind that knowledge equips you to make well-informed investment decisions and progress towards your financial objectives. That's really our goal tonight, is just to provide you viewpoint from a number of our guests tonight. And so thank you to all of our guests. It's been a lot of fun tonight. I've enjoyed this, and I hope everybody else did. So until we meet again, stay focused and disciplined on your financial journey. Thanks for coming out and enjoying it, and being with us this evening.
Thank you.
Okay, see y'all.
Bye.
Thank you, guys.
But